All right. Good morning, everyone. Thanks so much for joining us for this session. And I think it's a great opportunity to open up the content sessions with this particular panel because we really are at an inflection point, Darius, when we think about getting the credit markets rebuilt and building from the previous market versus where we are now.
Sorry, can you say that again? Can we...
Really are at an inflection point.
Yes.
Yeah.
Sorry, just to introduce myself. I'm Darius. I'm the founder of QCP. We are a digital asset wealth partner to high net worth and various clients. To answer your question, Joe, I think we are in an inflection point. I think we were just discussing before this that at the height of the crypto credit market, the size of the loan book was probably in excess of $30 billion. Right now, it's probably shrunk down to it probably went down to almost zero, and it's come back up to about $3-4 billion. And at the same time, we're seeing the institutionalization of a lot of parts of the credit market. So inflection point in the sense that we're seeing green shoots, that are there to help rebuild this market. And credit is the heart of every capital market. So I think a lot of the success of the space is going to depend on how the credit markets develop from here.
Yeah, and Chilling, a lot of this depends on how the market is starting to mature relative to where it was, 2021, 2022. Do you agree with Darius from that perspective that we are at that inflection point?
Yeah, it's a quick intro of myself. I'm the co-founder and president of Arbalos. We're a principal trading firm focused on derivatives and bilateral derivatives from the programmatic to the high touch. I completely agree. I think, yes, the credit market has shrunk tremendously, but I would say it's not necessarily retreated back to 0 or 1. I think it's shifted a bit in terms of how lenders are looking at the markets now, right? I think one is we've seen different infrastructure get built up a bit in terms of how they're lending to borrowers. So instead of just into a black box, uncollateralized, I think lenders are willing to be a bit more creative in terms of structuring things where they have visibility and transparency into an SMA account, or if it's on DeFi rails into a smart contract where they have partial control and visibility into what it's being used for. So I would say it's retracted, but it's also grown and shifted a bit versus lending markets 5, 6, 7 years ago, right?
Yeah. So Kevin, tell us a bit about KeyRock, and then also from your perspective, how we've seen maturity in the infrastructure, which is helping to mitigate some of that risk.
Sure, yeah. So I'm Kevin, co-founder and CEO of KeyRock. We're a market maker, liquidity provider on spot markets, options markets, active for 7 years now. I think that actually, we were just joking just before stepping in, the state of the lending market can be best described by who's on this panel, in that none of us is lending, we're all borrowing. And so I think that really says a lot about where we currently are. When it comes to the infrastructure, if you look at how we had to borrow 3 or 4 years ago, since then, we've seen a lot more kind of tri-party agreements being set up between large exchanges and custodian, which definitely allows us to reduce credit risk, reduce counterparty risk, and therefore allows us to borrow in a more efficient fashion. And so I do think it's part of the solution. So of course the market was hit very badly, 2 years ago, with most lenders actually going down. But we're seeing that now with this more mature infrastructure, this better understanding of what counterparty risk actually is definitely what allows the market to pick up, even though we still remain very far away from where the market was at its height.
Yeah, and Chilling, are you seeing bespoke lending? And then the second question to that is, how will this be achieved at scale? Is it a combination of what these bespoke solutions that are being provided? Is it a combination using existing capital market structure? And again, how you get that to scale?
Yeah, I think, going to the end of last cycle, we kind of saw a few lenders, large lenders dominate the markets, right? It was bespoke, but it was still dominated by large lenders like Genesis, Celsius, BlockFi. I think after that, market really fragmented, right? I think it went back to kind of just one-on-one with certain lenders that were still in the market and comfortable. But we are seeing it come back a bit into just more consolidation, because at the end of the day, I think it's impossible for these bespoke, it's almost like bilateral agreements. You can't have 20, 50, 100 bilateral agreements. It's very difficult to manage, right? So I think we're starting to see it come back in the form of quote unquote crypto native prime brokers Hidden Road and others, right? And I think we'll see what happens with BNY and custody and how that evolves. But I do think that the market will consolidate. It'll kind of go towards the larger firms, the larger balance sheet and lenders, because there's like a lot of economy to scale to like portfolio margining and offsetting risks and everything else.
Yeah, well, I mean, Darius, part of it too is when you have a proliferation of all these agencies that send credit and so forth, it's hard to determine and set those standards in terms of what credit worthiness is, right?
Right. Yeah. I mean, I think my view actually is that the banks probably need to be involved, right? The banks need to be involved. The previous cycle, what we saw was a lot of private lending. I think in the audience we have some guys who ran big loan books as well, and a lot of it was mispriced. A lot of it was mispriced, both in terms of how the speculative fervor, drove curves in different directions. The way things were being settled, bilaterally, like Shi Liang mentioned, it's all over the place. So I think the banks need to be involved to sort of set the standards, and also lend the balance sheet to get things properly priced. And to some extent, possibly, some sovereigns need to get involved as well in terms of being able to backstop some of this credit risk. And I think that's sort of the anchor from which, the cornerstone from which the markets get rebuilt.
Yeah, and do you see this, these alternative ways of capital formation, Kevin? Is this a trend that you expect longer term?
Absolutely. I think, I think it longer term in the sense that it's, right now, for example, the banks see crypto credit as completely separate and carved out from the traditional capital market, right? In their own words, they say that, if we take on a crypto-backed loan, they treat the crypto like a yacht or a car or something that is not credit worthy, right? So it needs to be, the two worlds need to merge, meaning that they need to start treating this like a capital market asset. And I think in the past, I think the duration of the crypto credit market was probably like 1 year, 2 years, 3 years max. And with capital markets merging, I think that tenor gets increased as well. And I think that's one of the signs of a maturing credit market as well.
Kevin, how influenced is this particular space as it relates to what's happening in the macro environment and the regulatory environment?
I mean, it's very much influenced, right? If you look at now, as Darius was saying, if you want to be able to benefit from credit from very large institutions, you need to be able to ring fence the risk, right? And part of that risk is potential regulatory risk. So if you end up, doing a deal now, with a regulated custodian, a regulated trade company, a regulated borrower, and have something, completely ring-fenced, it should be exactly the same thing as, working capital for commodities trading. There's no reason why it would be different. But that, that equation is completely impossible if you have no clear framework as to how each participant should be regulated. So I do think that at the end of the day, credit markets, when you have more certainty, when you have more clarity about how each player is expected to participate and the types of controls that they're going to be seeing, it is something that increases the trust in general in the market and makes it a lot easier to borrow and lend. So it is directly impacted. Anything that creates doubts and risk is negatively going to impact this market, and the reverse is true for more clear frameworks around the world.
Yeah, and Chen-Lin, we were talking about this backstage as well. When you have, all these jurisdictions and trying to establish these frameworks to advance the markets, do you think any progress is being made there? So in other words, what's your outlook as it relates to this space?
Yeah, I think just also touching back on the previous point about like banks, especially like Western central banks, I think like a main issue is like Basel III, right? I think like from a regulatory capital reserve perspective, like it's very difficult for banks to like actually get involved with crypto just from like a Basel III like framework, right? But like, and we are seeing a lot of like progress around the world. I think QCP is in like Abu Dhabi now, right? And so we're seeing different jurisdictions, pop up that didn't exist 2, 3, 4 years ago, as not necessarily like a safe haven, but at least like a lot more regulatory clarity for firms to move to and operate to than previously existed, right? And I think that's very encouraging.
Yeah, well, I mean, part of that too, Darius, is being able to do this at scale, right? With the integration of what we see with traditional finance and then decentralized finance lending solutions, it's really going to come down to how that advances.
Absolutely. So, I mean, exactly like Shi Liang said, the world that we've entered is very different from what we saw 2-3 years ago, right? I mean, now you have Bitcoin ETFs in the US. I think that provides a very different kind of framework as well, because these are securities familiar to banks, familiar to financial institutions. They would treat it as proper collateral. You have the BlackRock ETF options coming up as well. So a derivative market that forms there. You have a derivative market, you have a forward curve, and with a forward curve, you start to have a forward curve on securities. You start to have a proper bedrock from which you can draw a proper credit curve. I think, and then once the banks step in, you have wallet custody. I think that's how the space sort of takes off. So back to your first point about us being at an inflection point here, these are the absolute foundations and building blocks for what can be a credit market that was much bigger than what we saw before.
Right. Oh, especially Kevin too, when you're able to package them in products where you're able to provide risk management and package these in a way that's, people are familiar with that.
Indeed, it's interesting because we're talking about an inflection point, and what I find somewhat amusing is that right now as a market, we're trying to be as good as traditional finance when it comes to credit markets. Like, how can we be as good, right? Have a proper setup for custody, have potential better risk management system, well, just to be as good as the TradFi. But what is really interesting is how can we be better, right? And so I think that is definitely a part of the inflection point as should keep in mind is like, how can we introduce part of the benefits of decentralized finance in the credit market as well, to just go beyond being as good as the world that we're trying to somewhat replace or make evolve, and go to something that can actually be better in terms of transparency, in terms potentially of capital efficiency as well. So I think it's really that combination of not only going as far as traditional finance, being able to use part of the benefit of decentralization to bring this market to something that would be even more impactful and efficient.
Well, I think also too, once you get some standardization around it and you're able to quantify the risk that's associated with lending and these types of products, that will certainly help to advance it as well. But you also you want to be careful not to stifle the innovation as well. Over-regulate it. I mean, we've seen this happen with a number of asset classes. So I think that's something that you need to balance as well.
Yeah, I think to add to Kevin's point, right, the jump in efficiency is actually very subtle, meaning that what we see now is traditional markets trading on exchanges like CME and NYSE on a T+1, T+2 basis, 5 days a week, 12 hours a day, and what we have in crypto world is native liquidity is 7 days a week, live margining, instant settlement, auto liquidation, right? So this actually is very impacts the credit market a lot, because the settlement times and the response to, for example, the margin cost on CME is much higher than that on Deribit, precisely because the T+1 creates a lot more volatility in terms of settlement. So this difference, as our kids, for example, will probably be trading on exchanges that are more crypto than TradFi. And this is not even a technological change, it's just a method or a mindset change, right? And as that happens, the whole credit markets change. So this is not about how crypto, adopts TradFi credit. I think to some extent it's about how the TradFi world adopts the way crypto settles, and therefore the credit gets more efficient as well.
Yeah, well, I mean, that's a great point that you make. I mean, traditional markets are going to adopt the infrastructure that we're seeing within the crypto space itself. I mean, we just went to T+1 in May this year, and then the natural question is, well, why not T+0 if other markets are already functioning on that? And of course, there's a whole number of reasons why it won't. But when you think about it, at the end of the day, potentially this is what the new structure could look like. Because we tend to think very Western-centric at times, but the fact of the matter is local economies are being built right around these alternative forms of capital. Would you agree?
Yeah, completely. I think I mean, whether it's like T+0 settlement versus I think like tremendous advancements have been made 2-3 years ago in the decentralized lending markets, right? I think yes, we've seen a ton of a bit of a step back in the centralized bilateral markets, but DeFi rails, I think especially in terms new forms of collateral, we're starting to see not just Aave loans, which is deposit ETH, borrow stables. It's pretty simple. We're starting to see Pendle LP tokens as collateral. We're starting to see Uniswap LP liquidity pool positions as collateral. Not only DeFi, but we're starting to use and see that as collateral for OTC options trades, right? We've written options positions on staked ETH, as well as Pendle positions, as well as Uniswap positions, right? So I think that kind of melding between DeFi and CeFi, we've seen tremendous growth in the past 12 to 18 months.
Yeah, well, I mean, you think about it even further out than that, would you start getting demand for these products to be packaged, if you will, almost like we see in traditional private capital markets here? I mean, we've seen the demand for private credit, certainly. If you're thinking a few years out from there, if you get institutional investor demand for those types of packaged products around this type of lending, that's your inflection point. That's the conversation next year.
Sorry.
Yeah. So, once you start to see investor demand for these types of products or this type of lending to be packaged like we see with private.
Right. So, I mean, on that point, I think, what we are seeing is this bit of a bifurcation where the US focused market is very institutional, banks getting involved, guys like BlackRock getting involved, and that builds a credit market that looks very much like a TradFi credit market. At the same time, you're seeing, outside of the US, guys like Tether are now holding more treasuries than Germany, right? So they've become a sovereign in themselves. So there is a credit market that's on-chain, like Shi Liang mentioned. Some of it is in DeFi, some of it is bilateral. And that's a market that is huge and looking for structures as well. So a lot of innovations that we'll see will probably come out on on-chain, semi-on-chain, outside of the US, very stable coin-focused kind of credit markets. And I think that's something exciting. And for us, and everybody on this panel, I think what we want to do is sort of be that bridge, of credit from one institutional world to a world that is very stable coin-focused and
Yeah.
Sort of, yeah.
And Kevin, to wrap up here, it's interesting to see how this one side or the other ethos is kind of going to the wayside, and it's really going to be about merging the nimble technology that you guys bring to the table versus the scalability from traditional firms. But it really feels like the conversations over the past couple of years, that ethos, that divide, has certainly eroded.
I mean, I think it's a division that shouldn't be there. At the end of the day, if you look at digital finance in general, it's just an upgrade of technological capabilities. It doesn't have to be one world versus the other. It's just how can one learn from the other, and going both ways and getting something that is globally more efficient and on better tech possibilities. So I don't think that division is still there clearly, but I do think it is melting away to some extent and going to something that is a lot more seamless than it was. And clearly, both all three of our firms have a role to play there in making that bridge happen.
All right, gentlemen, appreciate the insight. Thanks so much for joining us this afternoon at Mainnet, and we'll see you around the conference. Thanks, everyone.
Thank you.
I did.